who can advise whether your decision is appropriate for you.
Glenn Stevens sees a worrying outlook for growth and employment in Australia, yet Wayne Swan says it's never been better and he's hell-bent on a surplus and he has his eyes on your super. That discussion coming up in just a few moments. Welcome to Your Money, Your Call Retirement. We have a huge show for you tonight and plenty of great emails from your fellow viewers, so do stay tuned and pick up the phone. Give us a call, 1300 30 34 35. My name's Sam Henderson, CEO and Senior Financial Advisor at Henderson Maxwell and author of Financial Planning DIY Guide and SMSF DIY Guide. You can find out more about me or Henderson Maxwell at hendersonmaxwell.com.au. Now, I do want to hear from you tonight, so please do give us a call, 1300 30 34 35, or email us right now at super@skynews.com.au. And this is your opportunity to get involved in the discussion tonight over the phone, via the email, or on Twitter. You can find me at Henderson_Sam. That's at Henderson_Sam. Now, tonight I do have a special offer for all of our callers. I'm going to give each and every caller a free copy of my new book, SMSF DIY Guide. So do make sure you leave your name and address and details with my producers so we can send out a copy for you during the week. And joining me tonight on the panel, a very stacked panel tonight, is my panel of experts, including Brian Ashenden, Technical Services Manager at BT, Kate Anderson, Head of Technical Services at Super IQ, and Graeme Colley, Director of Education and Professional Services at the Self-Managed Super Fund Professionals Association of Australia, known as SPAA, and they're here to answer your questions tonight. But before we jump into it, let's have a look at what's happening around the country at the moment. Blue chip shares. We've had a fairly good week on the share market. It's nice to see us over that 4,500 level on the ASX. AMP up 4 cents, pushing through the $4.50 mark at 4.51. ANZ up 20 cents, 25.50. The banks are in favour at the moment. BHP having a good day, up 1% at 33.32. Brambles up 7 cents at 7.03, and CBA sitting at 56.85. Moving on to the Cs and further. 45.85 for CSL, having a good day, up 55 cents. Macquarie up 37 cents, 29.65. NAB up 16 cents, around 26.31. Qantas having a good day, up 3 cents at 1.25. QBE having another good day. QBE looking reasonably cheap actually at 13.57, up 8 cents. Rio Tinto up 95 cents, up 2%. Cracking day for Rio. Stockland sitting even. Suncorp up 5 cents at $9.38. They've had a pretty good run recently. And Telstra shares another 2 cents. Defensive, expensive defensives has been the expression used for some of these high yield stocks, including Telstra, but it's looking pretty good at $3.95. Westpac up 31 cents, a bit over 1%, 25.88. Westfield up 2 cents, $10.34. Westfield's had a cracking run, as has the rest of the property sector. Wesfarmers up 29 cents at 34.55. Woodside off 8 cents. Bit unusual to see a bit of red there today, 33.14. Woolworths up 38 cents at 29.65. So that's what's happening across share markets across Australia at the moment. Looking at property markets, we can see what's happened with clearance rates across the country. Let's bring up that graphic if we can. Perth sitting at 55%, only 20 auctions there, so not a huge level of turnover. Adelaide, a fairly busy period, 45.8%. That's probably up from last week. Tassie, 25% clearance. Melbourne, 60%. Good to see it up over that 60% level again this week. Canberra, 47.7. That was up from last week as well. Sydney, 59.2. Pretty close to 60% and well over its average, which has been around 55 to 57% through the winter months, and plenty of activity there at 564 auctions. Brisbane, still a reasonably dismal 35.8. They're really struggling to get out of the 30s in Brisbane at the moment, so you probably wouldn't be auctioning your property in Brisbane right now, but it's good to see a flurry of activity across the property markets. Now, gentlemen, we've seen some action recently in politics across Australia. Graeme, we might start with you. I did hear that you were responsible for writing some of the superannuation legislation. What are your thoughts on all of this banter about Wayne Swan wanting to grab more money out of people's retirement accounts?
Sam, that's a bit tough blaming me for those sorts of things. But, yeah, I mean, what we saw the other week was seemed to come out of Swan's office about some dynamic changes to superannuation because the government at the moment really wants to get that money in and trying to balance its budget because it's missing out on that mining tax and capital gains tax is down. And some of those proposals I think should be quite alarming for those of us that may be moving from accumulation phase into pension phase. We might have reached age 55 or just retired, and we really need to be looking at some of those things that the government's thinking of bringing in. I'm not sure whether they really will, but it's certainly something we need to keep our eyes on.
So they're just throwing out a fishing line there and seeing what happens politically, or what's happening?
They usually run these things up the flagpole to see what people's reactions are. And I mean, one of those is that when you move from accumulation phase into pension phase, they're proposing to put in place some sort of capital gains tax arrangement that might hit your superannuation before it goes into pension phase. So what the detail of that is, we don't really know, but it's certainly been rumoured for many years in a number of reports as to how that could be raised.
Brian, you've been involved in a fair number of committees in looking at politics. What are your thoughts on the proposed changes or a few ideas that might be out there? What have you heard? What's the latest on the grapevine?
Yeah, Sam, I think it's always disappointing when you hear there's going to be talk about more changes to superannuation. It seems to come up every year, certainly around the budget, and obviously this year there's a lot of focus with the Treasurer wanting to deliver a surplus, and so obviously looking for ways that they can find some more money. So there's a number of things that are being talked about, such as Graeme was talking about, that possibility that when you move from accumulation into pension phase, you might have to pay a notional capital gains tax amount. Some of the things we're hearing is that it's a view that this is a rort or something that happens within the self-managed superannuation fund environment and doesn't necessarily happen in other superannuation funds. But that really comes down to the structure of those funds. It's a different rule for self-managed funds to others. So, I think in
retail and industry super, they pay capital gains tax, do they, when they move from accumulation mode to pension mode? Is that correct?
I think a lot of the industry funds do. I couldn't tell you which ones, for sure, but I think a lot of the industry funds do have that. Just because of the way they're structured, they can't in specie the assets across from accumulation to pension without actually selling it. A lot of retail funds do allow for that in specie, so it's not an issue there, which is why we say it's not just self-managed. I think really, the major thing here is if they're going to make a change, it should be something that's equitable across the board. It shouldn't be focusing on any particular segment of the superannuation market. And indeed, I think one of the previous ministers responsible for superannuation, Senator Sherry, recently came out and actually said, if the government's looking to do this, maybe what they should be doing is lowering some of the public servants' superannuation, where they're getting at about 15.5% contributions instead of the standard 9% that everyone else is. So
sure, I'd love to see that one go on the flagpole at Parliament.
Yeah, I'm not sure it's going to happen, but, we've got to find the right ones.
Yeah, Kate, what are your thoughts about the changes in super? I think we've got enough Australians disenfranchised from the superannuation system because of the level of complexity around it. What are your thoughts on these latest talks?
Look, I think so, and I think we've already seen major changes that are coming through this year that affect not only, say, your self-managed super fund people, but your high and also your low-income earners. So, effective this financial year, we saw the 30% tax on those people earning over $300,000, which is a new change this year, affecting high-income earners. And we also saw, say, for low-income earners, the reduction in the co-contributions. So the government has already targeted low-income earners and also high-income earners. But I think, agreeing with the panel, I think if they're going to do something, I think that they will perhaps will do it in pension phase, and they'll do it at fund level. So, in other words, I'm over 60, I have my money in pension phase, I'll still be able to draw it out tax-free, but it will actually be taxed when it's in the fund. So the mentality, I suppose, for people is that they'll still receive it tax-free after age 60. It'll just be now taxed in the fund.
So you're suggesting they're going to have an earnings tax, a capital gains tax in pension phase? Is that what you're suggesting?
I think, and that's what the rumour has been, that they will do it at that fund level, not at the member level, but at fund level. Yeah.
Right. Graeme, we've also heard the government propose or even talk about the raising of the preservation age, the age at which you can actually get access to your superannuation. At the moment it's 55. For people born after, July 64, it's age 60. Now they're talking about age 62. Is that going to disenfranchise people even further?
It may do, but I think that it will probably not give the government any more revenue if that's what the government's after with these things. I mean, our main concern with superannuation is the adequacy and whether you've got enough there for retirement. And putting the pension phase out, another 2 years or whatever's proposed, What will it really do? Will people save them all that more? Will they work a few more years so they can then start to draw down their pension from superannuation? I really don't know, but I honestly don't think it's going to give the government any more revenue than some of these other proposals are quite alarming as to what the possible tax take that they.
When they eliminated tax for people over the age of 60, it actually there wasn't a lot of tax coming for people over the age of 60 in the first instance, was there?
Right, yeah.
So it wasn't a huge loss in terms of tax, but it was a great win politically for the government at the time. But,
yeah, definitely. Yeah.
Have you done any research at SPAA in respect to the level and the size of the retirement savings gap in Australia?
It's huge. I mean, we estimate that people at the time they retire will need around about $1 million, and I mean that just depends on your salary. And I'm just looking at an average earner there, and I mean you're looking there at something that's based on about maybe 12 to 15 times their current income. That is around about what you could expect, but about $1 million for an average wage earner would be about right for a lifetime pension if they were going to draw that.
My understanding is the average female is retiring with 112,000, or aged between 60 and 65. She's got 112. The average male's got a bit over 200,000. That's a huge gap.
Oh, absolutely. And I mean, people in the 50-plus age group are the ones that are discriminated against when you see the government reducing the tax deductible contributions cap from 50 down to 25,000. And they're the ones who have missed out on the super guarantee, as the younger people have, and they're the ones that are really going to find it tough in retirement.
So theoretically, they should be encouraging retirement savings. Is that right, Kate? I mean,
that's right.
You know, they should be certainly encouraging women to save more.
I think so, because obviously there is that shortfall as well when people retire between men and women, because women take time out of the workforce to, you know, raise children. So, and I think I agree with Graeme. It's sort of the government should be there encouraging you to make more contributions into super, and we haven't seen that with this government, because we've been, you know, the amount that we can put in is now being reduced down to 25,000. So if someone is nearing and approaching retirement, they don't have that ability to be able to catch up and make extra contributions before they reach retirement.
Maybe a baby bonus superannuation contribution would be appropriate.
That would be quite good, yes.
Just throwing it out there. Brian, education around superannuation has been fundamental, but all of these changes, any time they talk about it, we're 6 months away from a budget, so they're really throwing the line out early here. But you know, how do we get people engaged? How do we get people educated about superannuation?
Yeah, look, I think it's one of those critical things that when you look at superannuation, it's there for your own future. So it's always important to take an interest in it. And a lot of people, they just sort of going through the working life, they've got the standard 9% going in, and that's pretty much as much thought as they give it. But really, when you think about it, next to your own home, superannuation generally is going to be the most valuable asset that you have in retirement. So it's really important, I think, for everyone to start to take an interest. You know, even with all these changes that get talked about, you know, the superannuation system is still good. You know, you have a maximum tax rate of 15%. You compare that to what your own marginal rates might be. It's still a great system for people to be able to utilise. So it's really important for everyone to do it. The government, you know, tries to help with some education. The ATO, I think, over recent times, is doing a pretty good job for people in the self-managed super fund industry, or within their own self-managed super fund, releasing a lot of booklets for trustees to understand their obligations, what they can do, where the risks come up, and so on. So, you know, it's there for everyone to have a look at and really take a good interest in, and really sit down and speak with a financial planner about how you can maximise those opportunities. Because even if they are going to make some changes, whether that be next year's federal budget or perhaps in a mini budget towards the end of November this year, the better you are on top of it, the earlier you've taken action, often you see that they come through with some grandfathering rules. It means if you're in place today, if you started a pension, they might not change that. It might be for new people that haven't done it yet. So the earlier you take an interest, the better off you're going to be.
Graeme, you're the Head of Education, or Director of Education at the Self-Managed Super Funds Professionals Association. What are the professionals doing out there to get better educated on the topic?
Well, there's a range of things. I mean, you see the accounting bodies introduce self-managed superannuation fund specialisations. We've had it for both advisors and auditors for a number of years now, and what we're trying to do is lift the competency of those people, and hopefully that results in better advice. And as Brian said, hopefully people are taking an interest earlier than what they would have, and they are really starting to build up their superannuation savings, but we're slowly seeing that occur. I think.
Now, those subscribers of the Eureka Report would have seen Alan Kohler and Bruce Bramall flying the flag for self-managed super funds, telling them to go and talk to the government, write letters and make a whole lot of noise. Are the proposed changes going to be focused on the self-managed super fund sector or disadvantage it in any way?
Well, you would think so, but I mean, as Brian pointed out, it's not self-managed superannuation funds that are solely going to be singled out. There are some of the larger superannuation funds who will get caught out and end up with that capital gains tax issue.
We have a caller on the line now. We have Jack from Victoria. Jack, go ahead. What's your question tonight?
Yeah, thanks, mate. I'm looking to diversify some shares in my super fund, and I'm familiar what the IPO stands for, but the FPO has got me interested. I don't know what it stands for and how it relates to running a ruler over accounts that I might invest in.
An FPO. I can't say I know what an FPO. Anyone know what an FPO is? No, I don't think we can actually answer that one. I take it it's an acronym, Jack. I haven't heard FPO before, so my apologies on that one. We do have to go to a quick break now, but do give us a call, 1300 30 34 35 for any question on retirement or superannuation, or you can email us at super@skynews.com.au. We'll be back in just a moment.
To those who combine dreams with actions, who don't think of what money can buy, but of what it can do. To those who count experience as part of their wealth. Always learning, always moving. To those who are always finding more, we say, you belong. Diners Club.
When a young person is diagnosed with cancer, it affects their family, their friends, their entire world. Red Kite supports young people with cancer and those around them in real ways.
Michael, I'm at the hospital.
We rely on your generosity to make a positive difference in the lives of thousands of families every year, because with your help, we can lighten the load.
Welcome back to Your Money, Your Call. My name's Sam Henderson, and tonight I'm joined by Brian Ashenden, Technical Services Manager at BT, Kate Anderson, Head of Technical Services at Super IQ, and Graeme Colley, Director of Education and Professional Services at the Self-Managed Super Fund Professionals Association of Australia, and that is a mouthful. They're here to answer your questions tonight, so do give us a call, 1300 30 34 35, and I always say there's never a silly question when it comes to your own money. That number again, 1300 30 34 35, or email us at super@skynews.com.au. If you do use Twitter, I'm at Henderson_Sam. That's at Henderson_Sam. Now it is time for Across My Desk, a new segment designed to keep you up to date with all the latest changes and views in financial planning, superannuation and, of course, retirement. Now, last night, and I mentioned this last week, I held a very busy seminar in the offices of 2UE in Sydney, and since I've had a number of emails and viewers wanting a sample of what was discussed, I prepared the following slides to give you a quick overview of the proceedings. Just a reminder, the topic was what your financial advisor should be telling you. So we might go to those slides now, give you a bit of a sample, I suppose, of what a financial advisor should be telling a client. The first thing you want to be focusing on is your needs, goals and objectives. How much do you need in retirement? How much do you want to save? What sort of income do you require? And they'll certainly be talking and discussing some of the financial issues that you might have, such as capital gains tax when moving assets around from outside of super to inside of super, etc. They'll certainly be looking at your cash flow and assessing that cash flow to make sure you've got enough cash flow to meet your expenses both now and forevermore. A good financial advisor should obviously be looking at your net wealth. They'll be looking at and assessing your funds, your property, superannuation and retirement, of course, looking at your debt levels, understanding risk and insurance management, looking at your tax situation. Hopefully they're well trained on that, hopefully specialists in the area, and of course estate planning, wills, powers of attorney, guardianship and aged care. What we do find though, as you move through your financial life, you might have a property or a real estate agent, you might have a share broker, you might have a mortgage broker, you'll have a tax agent, you might have a solicitor. So as you dance around all these different areas, what gets lost is that little person in the middle, you. And a good financial advisor should be putting together a strategy for you to meet your needs, goals and objectives both now and forevermore. And that is what an advisor should be doing for you. Moving on to the next slide now, the 7-step process. This gives you a bit of an overview of what to expect when you see a financial advisor. The first 2 steps are pretty much covered in the first meeting with an advisor, discovery and strategy meeting, getting a good understanding of your situation, understanding what your financial issues are, and developing a strategy and answering any questions that you might have. And specifically, they really, in my opinion, should be telling you how much tax you're going to save by the various strategies that might be available, and perhaps discussing a number of scenarios to benefit your particular situation. Perhaps it might be salary sacrifice, transition to retirement, account-based pensions, perhaps even assessing whether a self-managed super fund is right for you. Once you're happy to proceed, they'll put together a financial plan. This is now known as a statement of advice. This is a legal document. It must be in a particular format, and they will then present that form to you. And moving on to step 5, they'll help you implement that strategy. Sometimes they charge you for that, sometimes they don't. And then they'll do a post-implementation review and a regular review and ongoing portfolio management. Hopefully that is active portfolio management, but often we see a set and forget strategy put in place. We want to try to avoid those in best practice. Moving on to the next slide, we have the tax scales. As you can see on the far left-hand side, the most tax you'll pay in your own name is 45%. Obviously, we want to try to reduce that to the lowest possible level. Companies pay about 30% in tax, but when you end up distributing those funds to directors, often you pay the additional tax of up to 15% or 16.5%, including the Medicare levy. Trusts these days are less beneficial than they were before 1999, when you could distribute income to minors. These days you can't do that, of course, so you end up paying the marginal tax rate of beneficiaries. The next slide, the next arrow there is superannuation, and the benefit of superannuation, of course, is it's a concessionally taxed savings environment designed to fund retirement. And when you're over the age of 60, you pay no tax if you're retired. No capital gains tax, no tax on earnings, and no tax on the income that you draw from your superannuation. And that's one of the key benefits at the moment under the current legislation. There's my disclosure, and under the superannuation environment. So what we try to do often with clients is moving them out of their moving assets out of their own name, which is a capital gains tax event, into superannuation and then into an account-based pension in retirement. And often this is a good strategy for buying property. If you're looking at buying property or buying shares, you might be better off doing it inside a super fund with the prospect of not paying any tax further down the path when you're looking at disposing of that asset. Moving on to the next slide now, you can see a lot of financial planning is really about gap analysis, looking at where you are now and where you want to be, and a good financial advisor should be drawing up a roadmap for you to participate in some of the strategies that might be beneficial to reducing your tax and boosting your super. And they might include salary sacrifice, co-contributions, transition to retirement. You can now gear in your super fund, so you can borrow to buy property, you can borrow to buy shares under a warrant structure. There might be a reduction of capital gains tax. There's a whole bunch of strategies. It's really an infinite list at the end of the day, and that should be carefully tailored to your particular situation. One thing ASIC has been cracking down with financial planners is a cookie cutter situation where financial planners all do exactly the same thing for every client. Your financial plan or statement of advice and your ongoing advice should be carefully tailored to your particular and specific situation. Moving on to the next slide now, you can see this is possibly the most confusing thing about superannuation is your contributions, getting money into super. Your concessional contributions are limited to $25,000 per annum. That includes your superannuation guarantee, your salary sacrifice, and for self-employed people, you can put a lump sum which is tax deductible of $25,000 per annum. The confusing part is there, before July 1 of this year, that was $50,000 per annum for people over the age of 50. And it has been reduced down to 25. It is certainly said amongst the industry that that is too low. Let's hope at some point they raise that, hopefully in the next 2 years or so. The other side to contributions is non-concessional contributions. Now, you're limited to $150,000 a year, or if you're under 65, you can actually put $450,000 in a lump sum and then nothing for the subsequent 2 years after that particular financial year in which you make the contribution. Now, they're after-tax contributions. There's no tax when it goes into the fund. It includes lump sums, might be from the sale of a property or an inheritance, or even savings or a term deposit that you might have in your own name. You can put some money into super. Once you're over the age of 65, you're limited to $150,000 per annum, and you must meet the work test to be able to contribute to superannuation. So we've got to send you to work 40 hours in any 30-day consecutive period. So that covers off superannuation contributions. We get a lot of questions around contributions to super on this show, so do please pick up the phone and give us a call, 1300 30 34 35, if you have any questions in regards to getting money into or out of the superannuation environment. Moving on to the next slide now, I think we have a couple more left, is the investment philosophy. Most of what we've talked about so far has been based purely upon the strategies available to reduce your tax and to boost your super. We haven't talked about whether you choose NAB over CBA or Telstra over M2 Communications. Share selection hasn't even been discussed yet, and there's plenty of ways to save dollars without even being able to talk about specific shares or investments. But this is the tactical side of superannuation. The first section was the strategic side. If we look at risk versus return, understanding the difference between risk and return, understanding flexibility, volatility and liquidity and their effect on your portfolio. In the last 5 years, we've seen many companies become illiquid, many companies disappear off the face of the earth. So security is absolutely paramount. And that's why we always say there's never a silly question when it comes to your own money. And superannuation, by its very definition, as we said earlier, is a concessionally taxed savings environment designed to fund retirement. That is what it's all about, and that is what we should be encouraging. In my opinion, the government needs to be encouraging retirement savings and not confusing the populace any further than they already have. Let's reduce the complexity in superannuation and make it easier to save for our retirement and close that retirement savings gap that we were talking about earlier. Now, we do have a caller on the line. We might go straight to Lindsay. Lindsay, what's your question tonight?
I think my head's spinning. How's yours?
It's certainly spinning. I spent an hour and a half doing this last night, Lindsay.
We covered a bit of territory.
We sure did, didn't we?
Yes.
It was a big night.
Oh, okay. Initially, I rang up to say that I am over 60 and I have two share portfolios, a personal one and a super one.
Very good.
In self-managed super. And I now have the impression that within the next 12 months I should be transferring some of the shares from my personal to my super fund.
Mm-hmm.
What about concessional and non-concessional and caps and all the rest of it? What do I do about that?
Sure, there's a lot of issues in undertaking an in-specie or an off-market transfer, or in fact selling down a share portfolio to move it from a personal name, joint names, etc., into the superannuation environment. In fact, it is a capital gains tax event, as I'm sure my learned colleagues will enlighten you. Brian, what are your thoughts on Lindsay's question? What are her considerations?
Yeah, Lindsay, I think the first thing probably just overall to be aware of is if it is something that you're looking to do, certainly doing it by 30 June next year might be a positive step to take. The reason I say that is the government did announce a while ago that they were looking to bring in a rule that basically said if you want to move assets from your own name into your own superannuation fund, you need to do it on the market, which essentially means you would have had to sell it on the market and then buy it back again. So you can't do the in-specie or direct transfer that you're talking about now. They've since come out and said that they're going to bring that in from July 2013. So there's an opportunity to do it today. As Sam said, the first thing to consider is if you do that, it is a capital gains tax event. So you'll need to consider what your CGT position is and what the cost is of doing that transfer. As you've also called out, you do need to then be aware of the contribution caps. Now, at age 60, there's no issues about putting money into super. There's no test that you need to meet. But if you're putting it in as an after-tax contribution, you are limited initially at $150,000 a year, or a potential to do up to $450,000 in 1 year and not put anything in for the following two. You'll be able to do that as long as you haven't used this $450,000 rule within the last 2 years, so that's still available for you. Look, as a general rule though, having shares and direct shares held through superannuation and a self-managed super fund like you're talking about can be very beneficial, particularly where you're looking at blue chip shares that are paying fully franked dividends. Within super, whilst you're still accumulating, it's 15% tax on the earnings, but you get an offset for that imputation credit, which is basically a 30% rate. So it helps to offset other tax, or you might even get a refund. And if, in fact, at age 60, you have that opportunity, if you wanted to be running a pension, and you can put it a 0% tax environment, and that 30% imputation credit just comes back and adds to your superannuation savings. But really, the main thing probably is to really get some advice around it, just to look at all of those issues to work out how much of it, what's the right decision, what's the balance between in super and outside super.
Kate, anything to add to that?
No, I think Brian covered it very well. But again, all those issues, I think that's where it's important to go and speak to a financial planner. It's not sort of like a yes-no answer. It's like there's 4 or 5 really major issues that she needs to sit down with a financial planner and go through before she even attempts to say, yes, I want to transfer them in, or no, I don't. So the importance of planning.
Yeah. Graeme, a lot of people have direct shares inside a self-managed super fund. In fact, Aussie shares is probably the largest asset class in self-managed super funds. Any thoughts for Lindsay's particular situation?
Well, I think Brian covered it perfectly, but there's a couple of things there you might like to think about, is whether you get a tax deduction by transferring those in shares into your fund. You might qualify if you meet if less than 10% of your income comes from salary or employment sources. I think the timing of the investments and the way in which they go into the fund, I know this off-market transfer ban may come in from the 1st of July next year, but there might be a timing there because while Brian mentioned capital gains tax, there might be some losses that you've got on some of the shares you've held for some time because of the effect of the GFC, and there might be some capital gains there, so offsetting one against the other may save you some personal tax in that regard. So it's a strategic thing, and as Sam mentioned before, we haven't even got down to talking about the types of investments that your self-managed superannuation fund will be getting into. But that's why, as Kate suggested, you get a financial planner to look after that.
It depends on the cost base, of course. Any pre-85 assets will be not subject to capital gains tax, of course. So that's a consideration. It depends on what shares you've got and what capital gains is. If you've got a few years to age 65, of course, you can spread it out over a few years. If you do have a significant capital gains tax event by putting all of the shares in one go, you might want to spread it out over 3 financial years. And you know, at any one time, you can put some money in July, you can put some more money, put some money in June, and then put some more money through in July. But understanding those contribution caps is certainly well worth spending some time with a financial advisor about. The concessional contributions can be used to reduce your capital gains tax down to, say, 15%, because that's your contributions tax inside of super, and your non-concessionals can be utilised to ensure you don't pay any tax. And when your money's sitting in pension mode, of course, under the current legislation, no capital gains tax, no tax on the earnings, so you get all your franking credits back, and no tax on the income. So as Brian rightly mentioned, there's plenty of reasons to have it in the superannuation environment, but you don't want to go and trigger a large capital gains tax event. So Lindsay, thanks very much for your call. We've got another caller on the line, Dot, but please hang in there, Dot. We do have to go to a break right now. Please do give us a call, 1300 30 34 35, as Lindsay just has, for any questions on retirement, superannuation or financial planning, or email us at super@skynews.com.au. We'll be right back in just a moment.
Upgrade now to a more progressive lifestyle with the Audi Technic packages. Complimentary upgrades with an additional range of features like MMI navigation on eligible models from the sophisticated Audi Q5 range, the prestigious Audi Q7 range, and the innovative Audi A4 range. This complimentary value is only available for a limited time. It's all in the Technic at your preferred Audi dealer today.
This is Sky News Business.
This program brought to you by Diners Club. For those who belong. Diners Club.
Welcome back to Your Money, Your Call. My name's Sam Henderson from Henderson Maxwell, and tonight I'm joined by Brian Ashenden, Technical Services Manager at BT, Kate Anderson, Head of Technical Services at Super IQ, and Graeme Colley, Director of Education and Professional Services at the Self-Managed Super Funds Professional Association of Australia. And they are here to answer your questions on retirement and superannuation. So pick up the phone, give us a call, 1300 30 34 35, or email us at super@skynews.com.au. And speaking of Dot, we have a Dot from Victoria. Dot, go ahead. What's your question for the panel tonight?
Hello, Sam and panel. Sam, I want to inquire about transition to retirement. My financial planner has just organised it for me, and I'd like some reassurance that I'm doing the best that I can do.
Sure.
My earnings are $45,000 a year, and I've got $60,000 in super. I'm eligible for the pension in January. I've got $30,000 in 5% and $25,000 in 4.4% with the Commonwealth Bank.
And they're in your own name or the super fund?
They're in my own name.
Right, okay.
And I own my own home.
Sure.
Superannuation's great, but what if I don't live for 20 or 30 years? You know, you need to live a bit now too.
Sure.
Should I? What do you advise?
That's a great question, Dot. We certainly have heard a lot of questions like that over the years. Gentlemen, what are your thoughts on this one? We might start with you, Graeme.
Gee, I think that you've transitioned to retirement pension. Using that, I assume you're still working and you're just coming up to pension age. If you happen to pass away, you've got to work out your estate planning there and how you would pass that on to any beneficiaries you've got there, maybe adult children or your spouse, I don't know your situation. And maybe use the tax benefits that you might have, although when you're on a salary of $45,000 and you've got those investments, whether they be in superannuation or outside, you've just got to look at the tax position. So that's why we've got people like Sam, who's a financial planner, that look at those sorts of strategies and whether they're going to be tax effective for you. But that's basically how I would see it.
Kate, what are your thoughts on Dot?
Yeah, look, there's a lot of talk around transition to retirement, and most people generally say that if you're over 55 and you've got a considerable amount already accumulated in super, then this is the strategy that you need to do between 55 and 65. Obviously, if you're still working, at least probably on a part-time or full-time basis, and you're trying to, say, salary sacrifice as much as you can into super, into that concessionally taxed environment, and then move whatever you've accumulated during your working life into pension phase and start drawing down from a pension, particularly even more beneficial over age 60 because it's tax-free, and therefore you're supplementing your reduced income. So they've become a little bit less effective with the amount that you can put into super, which is being reduced to $25,000 for everyone. So I think, again, as Graeme said, that's where the importance of a financial planner comes in. Obviously, go in, see him, look at doing all the numbers, working out your whole tax position to see whether or not it's worthwhile, and then also going to the next phase and saying, if this is what I'm going to set up, what happens if I do pass away? How can I structure it the best way for my dependents or non-dependents when I do pass away?
Maybe Dot wants to use it all now to buy a caravan or four-wheel drive and travel around the country.
Why not? Why not?
Is short, Dot, no doubt about it. Brian, what are your thoughts?
Dot, look, I'd say that I think the first thing is it's good to hear that you've actually got a financial planner to help you make these decisions. But it's probably also, I think it's good that you're questioning whether it's the right strategy for you. And that's not me saying that what they've advised you isn't wrong, isn't the right thing to do, because I don't really know all of your personal situation, besides you've given us some details tonight. But it's good that you're actually taking that interest to work out, is it still the right thing to do? And you've got to be comfortable before you proceed. I think the one bit that I'll add to what the guys have already said is you're saying that you're eligible for a pension in January. I'm assuming that's probably an age pension or something similar. If you're concerned about whether the transition to retirement pension is going to affect you from an age pension viewpoint, in a realistic sense, it's not going to make much of a difference at all. Once you hit age pension age, your superannuation assets are going to be assessable for Centrelink purposes anyway. So whether it's in a pension or whether it's an accumulation, it will count. So it's not going to harm you in that respect. It really is just the case of working out what do you want to do, how much money do you want now to live your life today, and what do you want to save for the future or leave for your family.
Yeah, Dot, just having a look at the numbers there, one thing that we often do is to make non-concessional contributions to super. So your money sitting outside of super, you're currently sitting in there, I think 4.4% you said, and the other one was around 5%. What you're currently doing is paying tax on that. So you're not actually getting 4.4%, you're currently paying about 32.5 cents in the dollar on the interest from those. That would probably be better off inside the superannuation environment, because you're not, or you certainly, once you're over 65, you won't be paying any tax on those. because we can set up an account-based pension for you. So often it's good to have money in the super fund. Once you've reached pension age, or you have retired, you've reached a condition of release. So essentially you can get access to that money, same as you can in your own name. Now, I assume if you're close to pension age, you're 64 and a half for women, 65 for men, of course, and it's 65 for women very shortly. And you can get access to your superannuation at that point in time. So at the moment, you're actually paying unnecessary tax on the money sitting in the term deposit. So that's probably better off utilised in the super environment. And quite rightly, I think your financial plan has recommended a transition to retirement pension, because at the moment, if you're on $45,000 a year, you're paying 32.5 cents in the dollar, and under a transition to retirement pension, we can reduce your maximum tax down to 15%. So I think he's doing the right thing there for you. What I would probably want to see from him is a calculation, so you can actually see, I will be saving $2,500 a year by following this transition to retirement strategy. That's probably what I would be asking from him, so you can see a financial benefit for you at the end of the day, and that way you have a justification for following that path. The other option, of course, is to go and see somebody else and see what their options are, but I think you've probably been recommended the right path there, Dot, but I'd certainly be considering putting those other monies outside of super into the super environment. Dot, thanks very much for your call tonight. Make sure you leave your details with our producer. We'll send out a copy of my book, SMSF DIY Guide, for you. We've got another caller on the line, Jenny from New South Wales. Go ahead, Jenny. What's your question tonight?
Hi, thank you for taking my call. I have a question is, I'm not happy with why super levy fee jumped so fast from $45 to $200 every year now. It's just too fast.
Yes, very good question, Jenny. Graeme, we might go to you on this one. The superannuation levy for self-managed super funds has jumped in cost. Tell us about it.
Well, the reason why that increased was simply because of the government bringing in new rules, and the cost of administering self-managed funds from the ATO's point of view certainly increased. So whether you're getting a better service from the regulators, I really don't know on that, but that's the main reason why it increased. It went from 45, I think, to 170, and now you're looking at 200. So you're seeing quite a lot of change in the financial planning environment, in the regulatory environment, and rather than that just coming out of the government coffers, we now contribute to that as trustees or members of self-managed superannuation funds. So unfortunately, Jenny, that's the story.
Very good. Any other thoughts there, Kate?
No, unfortunately, yeah, it's just increased dramatically over the last couple of years and up to $200 this year. And again, what we were talking about previously, that the government has already introduced these different measures to hit high-income earners, low-income earners, and also even your self-managed super funds by increasing that levy up to $200 to obviously to increase the revenue that they're getting.
Each year we've seen the number of self-managed super funds increasing. This latest quarter, I think, was by about 7,000, a bit over 7,000. So there's certainly been significant growth in the sector, but we're also seeing quite a number of funds being closed down. Do you think people get a bit surprised by the price or the amount it costs to administer a fund each year?
Do they get surprised with? I don't think so. Probably the reason why I think people set up self-managed super funds, and then perhaps the reason that they think that they don't want it anymore is because they find out that they're ultimately responsible for looking after the fund, that as a member they are also the trustee of the fund. So whatever happens in that fund is their responsibility, which is very different if you're in an industry fund or retail fund. So I think the added responsibility is maybe the reason for people closing down their self-managed super funds rather than the actual cost of running it.
Cost versus benefits. Brian, what are your thoughts on this one?
Yeah, it's look, it's one of those important considerations you need to think about and take into account if you want to set up a self-managed superannuation fund. What's it going to cost you? What's the reason that you're going into it? Again, I think one of the reasons you see a lot of funds shutting down is it's not that people don't like it or don't want to be in it, but often you actually have people as they get into retirement and later years, they either just don't want that responsibility anymore. They've worked out that the assets that they have inside their super fund, and as you're in retirement, you tend to have a lot more cash investments, that you can equally hold those sorts of investments in just inside a public offer fund or a retail fund, and have your money coming out still tax-free, and you don't have that added responsibility, or maybe just off travelling around the place, so it's just harder to spend the time you need to. But it really comes down to what do you want to achieve? Why do you want to have a self-managed superannuation fund? They work really well. But they're not for everyone. It's really just working out what's right for you, and that's why it's important to get advice before you go and set one up.
I always joke that 30% of my client base is dragging a caravan around this great wide country of ours at any one time. So there's a lot of people that actually want to be disconnected from what's going on in share markets and the like when they're on holidays. The last thing they want to be doing is sitting on Cable Beach worrying about what's happening on the share markets. So certainly some good reasons for not having a self-managed super fund if you don't want to be concerned about what's happening out there. We do have to take a short break now, but do give us a call, 1300 30 34 35 for any questions on retirement, superannuation or financial planning. You can email us at super@skynews.com.au. We'll be back in just a moment.